Halftime, let's get to our Courtney Reagan with today's ETF Edge.
Hi there, Frank. So whether implemented now or later, one of the major arguments against tariffs is that they can spur inflation. Our next guest believes too many investors think inflation is in the rearview mirror, but that they should still consider it a very real and possibly building headwind right now. So joining us is John Davi. He's CIO at Astoria Portfolio Advisors. John, thanks for being with us. I mean, look, as we mentioned, you say most investors' portfolios are not currently prepared for higher inflation.
Yeah, I mean, a lot of the portfolios that we oversee and we see in the marketplace is still very much tech and growth and have very little exposure to real assets, sectors like energy, materials, industrials, sectors that benefit from higher inflation. So we don't think people are prepared for an extended period of tariffs, and which tariffs are inflationary in by nature. So we don't think people are prepared for it.
And here we are. What a day to have you on here. I mean, obviously, you're going to talk your book because you run an inflation-adjusted fund. So how does it work? Tell us about it.
Yeah, well, the funny thing is we launched this fund in December 2021, and people thought that, inflation was not going to be around. And since then, if you look at core PCE, we're still at 2.6. The Fed's target is 2%. Once inflation, genie comes out of the bottle, it's very difficult to put it back in. And if you were to extend your chart and your screen back to 2021, you'll see that cumulatively the spread between PPI, our fund, versus S&P, for most of the period, we actually were outperforming the S&P, but that, closed, with the Mag 7 run up. So what we do is we allocate across 50 different stocks and or ETFs that benefit from structurally higher inflation. So that's oil and gas, parts of energy, industrial materials. We also added recently data centers, power plays. So in aggregate, it's a 13 PE ratio, which I think is pretty cheap. And we're picking, the best in breed stocks, ones that are higher quality within those sectors.
Okay, so outside of that, I mean, how else are you advising clients to diversify, spread risk around in their portfolios for everything that we're having to manage right now?
Well, we're global macro investors. We don't love buying the S&P or the Qs, let's say. We think you should be tilted away. The Mag 7 stocks are very, very expensive. If you look, earnings growth for the Mag 7 stocks is projected to be 20% by the end of this year. The S&P 493 is projected to be 12%. So that spread of 8%, that's narrowed significantly. Last year, that spread was like 33%. So we think you should be buying, very idiosyncratic stories, whether it's things like PPI, which are inflation beneficiaries,
right,
or KBWB, the money center banks, or even tilting towards equal weighted strategies.
Okay, some good ideas here on a day where inflation and tariff is all the talk of the town. Thank you very much. Much more on inflation fighting tactics and quick diversification coming up on ETF Edge. That's at 1 p.m. Eastern. John will be joined by Todd Rosenbluth. He's head of research at VettaFi, etfedge.cnbc.com.